Hey guys, and welcome back to the channel. Today we're going to be breaking down three top UK consumer non-durable stocks that I think you should buy and hold forever in your portfolio. Now, remember, today is just a little bit of a stock analysis into these three UK consumer non-durable stocks that probably have something mostly in common, in my opinion, which is strong brands, high cash flow, defensive business models, and the ability to survive almost any economic environment. Now, this is all my opinion. This is from what I've done in my past in my research. So please remember, this is not financial advice. All content is for educational entertainment purposes only. Please always do your own research and make decisions based on your personal circumstances. Investing involves risk. You can lose money, and past performance does not guarantee future results. And I could also be very much wrong in my stock analysis. So the first one, and as we can see, is British American Tobacco. Now, it's one of the world's largest tobacco and nicotine companies. Now, on their website, a message is very much clear, and as you can see, very much straight in front of us, a better tomorrow. Now, to me, that is signaling a long-term shift away from traditional cigarettes and towards reduced risk products. Now, their portfolio includes quite a lot of some legacy products that you probably might already know, or you might have yourself that you've used, or you know of people using. And that is like mostly like cigarettes. So their brands like Donnell, Lucky Strike, Kent, and Pall Mall, they're all like the old-fashioned, like your cigarettes and stuff like that. They're the combustibles. Now they do have some new categories. So they have Views, which is a vaping product. Glue, which is heated tobacco, and a Velo, which is nicotine pouches. Now, this dual engine model is the core of BATS today. It's like the milk, the cash cow. Invest in the future. Now, how do BATS makes money? Well, BATS generate revenue through cigarette sales, which is still the majority of profits. Vaping devices and pods, heated tobacco sticks, nicotine pouches, and licensing and distribution. Now, cigarettes remain extremely high margin, but the company is aggressively shifting towards non-combustibles, which now make up a growing share of the revenue. Now, as we can see here, year to date, they're actually up by 16.93%. A year ago, they're actually up by 47.33%, and 5 years ago, they're actually up by 73.18%. Now, they are ticker BATS. Now, they're actually at 4,875 GBX. Now, like I say, they're in industry tobacco. They have a market cap of 105 billion, an IPO in 1962 with a dividend yield at 5.03%. Now, the revenue in 2025 was 25.61 billion. Now, that is actually down by 0.99% year over year. This decline is expected because, like we say, they are shifting away from cigarettes. Their volumes are falling and globally every year. But they try and offset that with pricing power and growth in new categories. Now, from the profitability sheet, their PE ratio is at the moment at 14.01. Their ROE is at 15.82%, and the free cash flow yield is actually at 5.47%. These numbers show a company that is still a cash flow machine. Now, the balance sheet is actually debt to equity at 0.73% with net debt at 2.66. Now, of course, debt is high but very manageable. Tobacco companies typically run with leverages, hence why the debt is quite high, but because the cash flow is also predictable. Now, the market position is actually top two global tobacco company. Views is the #1 brand in the US with distribution over 180 countries with massive pricing power helping out with their market position, and high barriers to entry helps with them stabilizing their market position. This is a company with scale, brand power, and regulatory moats. Now, of course, there's a lot of industry trends with tobacco companies and products. Now, of course, governments are pushing for smoke-free targets. Vaping regulations are tightening. Nicotine pouches are growing rapidly. ESG pressure reducing institutional ownership, and high dividends attracted income investors. But of course, there's always risks that come with it. And that is regulation crackdowns, decline in cigarette volumes, slow adoption of reduced risk products, and currency fluctuations. But there is some good news for British American tobacco. In the news lately, the US Senator urges RFK to resist easing vape rules. This increased regulatory uncertainty for vaping is a key growth area for BAT, short-term negative, long-term manageable. But analysts raised 12-month price target to 4,840.91. Now, luckily, the price is actually just above that, but this can apply a little bit of an upside if it can go on further, but reflecting a stable cash flow and strong dividend support. So at the minute, we are actually above the analysis target, so that will show a little bit of a downside. But analysis targets are supposed to be good because when they get raised and they get raised above the share price, that is when the stock rallies a little bit because there's a lot more room to run, which looks like it happened in the last few days because this news actually did come out 2 weeks ago and the price has already increased just above that. So it looks like British American tobacco is doing quite well indeed. And then we move on to one of the UK's most loved bakery and one, of course, my most loved bakery, which is quietly doing its a powerful story in the background. That is Greggs. That is everyone, right? That is Greggs. Greggs is one of my most favourite bakeries in the UK. And of course, they're the most iconic bakery chain. Their website pushes to Greggs app, which is a main driver of the loyalty and repeat purchases. Now, they operate over 2,500 stores and a vertically integrated supply chain. Now, they do have a retail plus B2B segments. Now, Greggs is just not a bakery. It's a value-focused food retailer with a cult following. Especially like myself, I am very much the use of the Greggs app, and I make sure I collect my rewards every time I go in. But how do Greggs make money? Well, they do in-store bakery sales. They actually do delivery partnerships. They have a breakfast and coffee expansion now, which I take care of. Meal deals, seasonal products, and app-driven loyalty. Greggs is essentially the McDonald's of the UK bakery. High volume, low price, consistent demand. And as we can see here, year to date, they're actually up by 2.31%. A year ago, they're actually down by 20%, and 5 years ago, they're actually down by 31%. So there's still a little bit of leg room to run. But as you can see, they're actually at 1,726 GBX. They're actually got a market cap of 1.76 billion. They IPO'd in 1986 with a dividend yield of 4%. But not just that, the revenue in 2025 was 2.15 billion, which was up 6.79% year over year. Now this is strong, consistent growth driven by probably new store openings, delivery expansion, their breakfast and coffee sales, and app adoption. Now of course, their margins are modest but stable, typical for food retail. Greggs wins through its scale efficiency and its brand loyalty. They also have low debt, strong cash generation, and financial management, which is really good. Now, of course, their market position, I think, as we already can gather, is the UK's one bakery chain. They are the top one bakery chain. They're dominant in the high street presence. They're expanding into travel hubs and petrol stations and a strong brand loyalty. Yep. Like I say, I travel down south to go and see my sister who's in uni. And honestly, I think I stopped like 3 times and there's a Greggs in pretty much every petrol station that I go and see, which is lovely because I can just grab a latte, I can just grab a steak bake or something like that, or even just a sausage roll, just one of the sausage rolls that just comes out nice and warm. I'd love it. So that is why they're expanding and doing very well in their market position. Their growth in grab and go food, the digital ordering and loyalty apps helps their industrial trend. They're also, like I say, expanding into breakfast and coffee markets, which a few other coffee shops have done, but I just don't think they've done it as well as enough as Greggs. Now, of course, there is very much a risk to this. Food inflation, wage increases, competition from supermarkets with their meal deals, and weather-dependent footfall. But people a lot say that Greggs isn't great when it's raining, but I actually think it is because when it's cold and you're getting wet, why would you go and just go and do shopping? You want to go and warm up, and Greggs do brilliant foods, and I've seen Greggs busy when it's like that. So weather dependence a little bit, on the fence for me, but I still think Greggs can do it no matter if it's rain or shine. Now, of course, there is some good news for Greg. Strong sale growth continues. Like I've mentioned, Greg continues to outperform expectations with demand, and analysts are loving that because they maintain strong momentum despite the cost pressures, especially with the Iranian war. Greg's remain one of the UK most reliable consumer stocks, and this is why I would add it to my portfolio. And of course, lastly, we have got Premier Foods, or PFD, which is a quiet compounder in my opinion. And Premier Foods is one of the UK's biggest packaged food companies. Their brands include like Bistro, Oxo, Sharwood, Mr. Kipling, Ed Bachelors, and even more. Now they operate in the grocery and the sweet treats sector. Their brands found in almost every UK household. And how do they make their money? Well, they do that by selling branded packaged foods, own label manufacturing, retail partnerships, and seasonal products. Now, due to this is high volume, so they are very much stable in recession-resistant business. Now, of course, they've done quite well. They're actually up by 17% year to date. They're actually down by 4% in 1 year, and 5 years, they're actually up by 84.95%. Now they're actually up on the price of 201.6 GBX, market cap of 1.77, IPO'd in 2004, with a dividend yield at 1.63, which is one of the lowest of today's video. But their revenue in 2026 was actually 1.18 billion. Now, up 2.31% year over year, and the half-year revenue was actually up 4.66% of 673.4 million. Now, this is steady, reliable growth, exactly what you want from a defensive stock like PFD. Now, the PS ratio is 1.48, and like I say, the market cap is at 177 billion. Now, margins are expanding as the debt falls, branded sales grow, and supply chain efficiency improves. Now, in my opinion, their market position is one of the largest branded foods manufacturers in the UK, especially dominant in gravy, cakes, and sauces, which we use pretty much every day in our lives. And they do have a strong supermarket relationship. And I think that's what makes it the quiet compounder. Not flashy, but just extremely reliable. Now, of course, they do have some industry trends like growth in at-home cooking, rising demand for value brands, increased supermarket promotions, and so on. But with that, it does come some risks, like commodity price inflation, private label competition, and changing consumer taste. But like I say, the news has been great. As mentioned, the profit is up in cash flow surge, with the dividend actually up by 20% growth. That is right. Due to the strong branded growth and improved margins, they grew their dividend by 20%. Now, robust 4-year results, so the momentum continues across grocery and sweet treats. And of course, the one and only things that you like to see, and that was guidance raised. Management was so confident that it continued in growth that they raised their guidance for their full year. Now, these three companies, in my opinion, share key traits: strong brands, high cash flow, defensive business models to survive any outcome, long operating histories, but ability to pass on inflation. Now, they do operate in industries where demand stays stable even during recessions. Now, that is my opinion, but if you did enjoy this breakdown and it's still a stock analysis, leave a like, hit the subscribe button so you don't miss out on any more of these stock analysis videos. And if there's any other sector that you want to see, comment down below, or if you have these in your portfolio, let me know. And what do you think about these three stocks? See you on the next one.